Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
Today, we're plunging into a really intriguing question. How does the media, maybe in ways you haven't thought about, actually influence corporate governance and specifically insider trading?
That's right. We've got a single, really fascinating research paper to unpack for you.
And it's absolutely full of eye-opening insights, those aha moments.
Indeed. Our job today is to take this, quite dense academic paper and turn it into a clear, engaging conversation.
Helping you grasp not just what the authors found, but maybe more importantly, why it matters.
Exactly. We're looking at a topic that really touches everyone, individual investors, sure, but also top executives, board members, anyone advising on corporate strategy.
Absolutely. Today, we're diving into the governance effect of the media's news dissemination role. Evidence from insider trading. Bit of a mouthful.
Yes. It's by LILI, Jerry PARWADA, and BOHUI ZHANG, published back in 2015 in the Journal of Accounting Research, a top journal.
Think of this deep dive as your shortcut, your way to get quickly up to speed on a surprising aspect of corporate oversight. We'll use 6 key questions to guide us. So, let's jump in.
Sounds good.
Okay, first question then. Let's kick this off. What is the core research question these authors are trying to answer, and why is it actually important?
Right. So, at its heart, the paper asks something pretty fundamental. Does the media, simply by sharing existing news, not creating it, but just passing it on, does that act play a role in corporate governance?
Okay.
And even more specifically, can this simple act of, let's say, rebroadcasting information directly affect, maybe even restrict, how much profit insiders make from their trades?
And you highlighted that distinction, dissemination versus creation. Why focus just on the sharing part?
Well, that's what's really novel here. We kind of know the media can expose scandals or pressure managers, right? That's the creation side, the investigation. But this paper looks at something maybe more subtle, the dissemination role. They use a very specific setting, SEC Form 4 filings.
The insider trading reports.
Exactly. Insiders legally have to report their trades. The SEC makes this public. Then, often, news outlets like Dow Jones just repeat it. They rebroadcast it.
So it's already public info, but maybe buried.
Precisely. And the authors argue that how much insiders profit from their trades is seen as, and I'm quoting here, one of the most tangible signs of poor corporate governance.
Interesting.
So if the media, just by making this existing, maybe obscure information visible, can curb those profits, well, that has big implications for market fairness, for corporate integrity, for, how level the playing field feels.
Got it. So it suggests this passive monitoring role just by shining a spotlight. Okay, so we have the main question, but they didn't just ask if it happens, right? They dug into how it might work.
Exactly. That's where it gets really interesting. They develop a main hypothesis, H1, which they call disciplining via dissemination. Basically, H1 states, media coverage of insider trades reduces the profitability of insiders' future transactions. Simple enough.
And the alternative, the null hypothesis.
The null would be, well, if the media is just repeating stuff, adding no new info, it shouldn't matter, unless maybe insiders perceive the media attention itself as a threat, to the reputation or job.
Okay, but they went deeper than just that main hypothesis. You mentioned they identified specific ways this could happen. Channels?
Yes, 3 distinct economic mechanisms, or channels, for how this disciplining effect might operate. These are their additional hypotheses, H2A, B, and C.
Let's walk through them. What's the first one?
First up is the information asymmetry channel, H2A. The idea here is pretty intuitive. When the media broadcasts news about past insider trades, it reduces the information gap, the asymmetry, between insiders and everyone else.
Makes sense.
So prices adjust faster to the information that was maybe only known to insiders before. This directly cuts into the potential profits from future insider trades. They suggest this effect is stronger in firms with lower information transparency, where things are naturally more opaque.
Okay, leveling the playing field through information spread. What's the second channel?
Second is the litigation risk channel, H2B. This one suggests that more media attention makes insiders worry more about getting sued.
The legal threat.
Exactly. The paper notes that a huge chunk, like 40%, 60% of all securities class actions involve allegations of insider trading. Litigation is a real risk.
Yeah.
So if you're an insider and suddenly your trades are all over the news, you might think twice about making a potentially dodgy, even if profitable trade. You might play it safer to lower your litigation risk.
Makes perfect sense. And the third mechanism?
The third one is the capital at risk channel, H2C. This focuses more on the personal, financial, and reputational stakes for the executives.
Okay, so what's tied up in the company?
Right. The argument is that extensive news coverage can directly hit an executive's personal wealth, think stock options, shareholdings, and also their reputation, which is a huge asset. So if an executive's personal wealth or professional standing is really closely tied to the firm's performance and image, the paper argues the disciplining effect of news is more pronounced. They simply have more skin in the game, more to lose from negative attention.
Wow. Okay, so it's not just one thing. It's information spread, fear of lawsuits, and personal financial or reputational risk all potentially working together.
Precisely. It suggests the media's influence is multifaceted. It pulls on different levers: market efficiency, legal fear, personal incentives. And finding support for all three really strengthens their main argument.
Definitely paints a richer picture. Okay, let's shift gears a bit. To make these claims stick, the research design has to be solid. How do they actually measure these things, collect the data, and importantly, address validity?
Yeah, the design is crucial. They use a really impressive data set. For the insider trading data, they got over 1.3 million trades by U.S. corporate insiders from Thomson Reuters. This covered January 2001 to June 2012.
A lot of data.
A huge amount. And importantly, they focused on officers and directors, the real insiders, excluding large shareholders who might trade for different reasons. This focuses the analysis.
Okay. And the news coverage. How do they measure that specifically?
For news coverage data, they use RavenPact, which tracks global news. They looked at Dow Jones Newswire alerts, again for a long period, Jan 2000 to June 2012.
And they filtered it carefully, right? Because you mentioned the focus on dissemination.
Very carefully. They filtered for news specifically tagged as insider trading. And crucially, within that, they zeroed in only on articles that were just repeating the regulatory releases of insiders' transactions.
Gotcha. Not original stories, just the rebroadcasts.
Exactly. That specific focus makes up over 98% of that news category, apparently. And they only used articles where the firm was the main subject, a relevance score of 100. This tight definition is key for their construct validity. They're measuring what they claim to be measuring, dissemination of regulatory news.
Makes sense. And how do they measure the profitability of the trades?
They used a standard finance measure called alpha, specifically the annualized abnormal return from the Carhart four-factor model over 180 days after a trade.
Okay, so basically the extra profit insiders made beyond what you'd expect given market movements and known risk factors.
That's a great way to put it. It isolates the potentially opportunistic gains.
So with that data and those measures, how did they build confidence in their results? Thinking about internal validity, statistical conclusions.
Right. For internal validity, making sure the relationship isn't spurious, they included a lot of control variables. Things we know affect stock returns or trading, like firm size, market to book, past returns, volatility, R&D spending, even how big the trade was, and how often the insider trades, all based on prior research.
Standard practice, but important.
Very. And for statistical conclusion validity, they use things like industry and year fixed effects, basically accounting for broad trends, and cluster their standard errors at the firm level. This makes the statistical tests more reliable when you have data structured like this.
And did they do robustness checks? Test if the results hold up under different conditions.
Oh yes, several. For instance, they reran analyses excluding trades made close to earnings announcements just to make sure those big news events weren't driving the results.
Smart.
They also looked at changes in news coverage over time and even managed to link the effects to specific insiders mentioned in the news reports. These extra tests really help with external validity, suggesting the findings aren't just a fluke of their main sample or method.
Okay, that sounds pretty thorough on the design front. But now, the really tricky part, causality. How did they actually run the numbers? And more importantly, how did they tackle that big challenge of endogeneity? Could it be that firms getting more media attention are just different in ways that also lead to less insider profit?
Exactly. That's the million-dollar question in this kind of research. Correlation versus causation.
So what did they do?
Well, they started with baseline regression models, just showing the association between their specific insider trading news measure, news coverage IT, and insider profits, alpha, controlling for everything we just discussed. They also included general news coverage, non-IT, to show it was specific news that mattered.
Okay, the basic correlation.
Right. Then they added interaction terms to test those three channels, information asymmetry, litigation risk, capital at risk. But to get at causality, they used two much more sophisticated techniques.
Here we go. What were they?
First, an instrumental variable approach. This is quite clever. They used a firm's geographic distance from the nearest Dow Jones News Bureau as an instrument.
Distance, how does that work?
The idea is firms further away are plausibly less likely to get covered just because it's more costly or difficult for journalists physically based at the Bureau. But, and this is key, how far away a firm is shouldn't directly affect its insiders' trading profits for any other reason besides this potential link through media coverage.
Okay, I see the logic. Distance influences coverage, but not profits directly.
Exactly. So in the first stage of the IV, they showed that distance does predict news coverage. Then, in the second stage, they use only the variation in news coverage that's predicted by distance to see its effect on profits. And they found this predicted coverage significantly reduced insider profits.
And they checked the instrument was valid.
Yes, they ran tests showing the instrument was relevant and strong, meeting the statistical requirements. It's a compelling way to isolate a more causal effect.
Very neat. And the second approach?
The second was a natural experiment. They exploited the fact that Dow Jones apparently formally initiated coverage of insider trading filings in January 2004.
Ah, like a sudden shock to the system.
Exactly, an exogenously positive shift in this specific type of news coverage. So they compare the effect of media before this policy change, say 2001, 2003, versus after 2004, 2007.
And what did that comparison show?
They found that the negative relationship between their news coverage IT measure and insider profits, alpha, only became statistically significant after Dow Jones started this systematic coverage in 2004. Beforehand, there wasn't a clear link.
Wow, so the effect really kicked in when the dissemination became more systematic.
That's the strong suggestion. Both the IV and the natural experiment really bolster the case for a causal impact of media dissemination on reducing insider profits.
Okay, that's some serious econometric firepower. So after all that work, the careful design, the advanced methods, what were the main results? Did the media's dissemination actually curb insider profits?
The answer is a clear yes. They found a statistically significant negative relationship between their measure of insider trading news coverage IT, and future insider trading profits, alpha.
So more news, less abnormal profit.
Precisely. The main hypothesis, H1, was strongly supported. The T statistic was -3.89, which is quite robust.
Can you give us a feel for the size of the effect? Is it meaningful?
Yeah, they calculate the economic significance. A one standard deviation increase in this specific news coverage was associated with about a 3.4% decrease in the annualized abnormal returns from insider trades.
3.4%. That's not trivial when you think about potentially large trades.
Definitely not. And just as importantly, they found that general news coverage about the firm, news coverage non-IT, had no significant effect on insider profits.
Ah, so it really isolates the impact to the specific news about insider trades being disseminated.
Exactly. It reinforces their core argument about the dissemination of that particular regulatory information.
Okay, and what about the three channels? Did the results support the idea that information asymmetry, litigation risk, and capital at risk were the mechanisms at play?
Yes, they found evidence consistent with all three channels operating. Well, for innovation asymmetry, H2A, the negative effect of news coverage on profits was stronger in firms where you'd expect higher asymmetry, like those with more disagreement among analysts about future earnings, high forecast dispersion. And interestingly, it was also stronger in firms not audited by the big top-tier accounting firms, maybe suggesting less pre-existing scrutiny.
Okay, that fits. What about litigation risk?
For litigation risk, H2B, the disciplining effect was more pronounced in firms operating in industries known for higher litigation risk. It was also stronger for insider sales, which courts tend to look at more suspiciously for intent, and stronger for officers compared to just directors, likely because officers face greater legal liability.
Again, consistent with the theory. And the capital at-risk channel.
And for capital at risk, H2C, the effect was magnified when insiders had more personal wealth tied up in the company, measured, for example, by their equity-based compensation. Also, interestingly, in firms with stronger corporate social responsibility scores, perhaps indicating higher reputational stakes.
So the results line up nicely with all three proposed mechanisms. Did they find anything else noteworthy in additional tests?
They did. A few interesting points. They showed the effect was primarily about reducing profits, not necessarily making insiders take bigger losses.
Okay.
Also, quite significantly, it was repeated news coverage that drove the effect, not the first time a trade was reported. This really supports the dissemination idea over the information creation idea. It's the amplification that matters.
That's a key detail, the repetition.
Yes. And finally, they found evidence that media coverage acts as a deterrent. It reduced the likelihood of insiders making trades just before earnings announcements, a period often associated with potential opportunistic trading. So it seems to stop some questionable trades from even happening.
So it's not just making trades less profitable, but actually changing trading behavior beforehand.
Exactly. It suggests a preventative effect, too.
Okay, pulling it all together then, what's the final conclusion the authors draw from all this? And given everything we've discussed, the theory, the design, the econometrics, do you think those conclusions are warranted?
Their main conclusion is pretty clear and direct. The media plays a significant corporate governance role simply by disseminating regulatory filings about insider trades. This act of rebroadcasting reduces future insider profits.
And it does so through those 3 channels we talked about.
Yes, by reducing information asymmetry, increasing perceived litigation risk, and activating concerns about personal capital and reputation at risk.
And are these conclusions well supported? Should we buy it?
I'd say yes, absolutely. The support is really quite strong across the board.
Why do you say that? What makes it convincing?
Well, first, the theory is well grounded. They didn't just say media matters. They propose specific, plausible mechanisms. Second, the research design is robust. They used a massive data set, carefully defined their key variables like the specific type of news coverage, and ran numerous checks. That helps with validity.
And the econometrics.
That's probably the clincher. Tackling endogeneity is always hard, but their use of both the instrumental variable, the geographic distance to news bureaus, and the natural experiment around the Dow Jones policy change provides compelling evidence for a causal link. It's not just correlation. They make a strong case that media dissemination causes the reduction in profits.
So the combination of theory, careful measurement, and those advanced methods makes the conclusion pretty persuasive.
Exactly. It's a really comprehensive piece of work that builds a strong chain of evidence.
It really has been an incredible deep dive. We started with this maybe seemingly simple question about media sharing news, and we've ended up seeing how this act of rebroadcasting regulatory info acts as a powerful, measurable force for corporate governance. It's not just about breaking news.
Absolutely. This paper offers real insight into the real effect of news dissemination. It connects to broader ideas about how external monitors like the media can discipline companies. And it kind of challenges the idea that only brand new original information matters for market efficiency. Visibility matters too.
So for you listening, what's the takeaway? I think it really highlights how transparency, even just making existing information more visible and repeating it, can have a profound impact on behavior inside corporations.
It suggests that simply increasing the visibility of required disclosures can be a powerful governance tool in itself.
Definitely. And it opens up new questions, doesn't it?
For sure. The authors themselves mention this. What are the knock-on effects? If media scrutiny curbs insider trading, does it also affect other big decisions managers make, like R&D investment? Or maybe M&A activity? Are there other associated outcomes?
Yeah. Could this disciplining via dissemination extend to other areas of corporate behavior? Maybe even areas beyond finance? It really makes you think about the fundamental benefits of the media's role, maybe in ways we haven't fully appreciated.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.